All right, today we're diving into something pretty fascinating. This is a pre-declared structural record for the S&P 500. Now, what does that mean? It's based on a framework called market DNA, which tries to map out the market's potential moves before they happen. So this isn't a look back with hindsight. This is a real-time breakdown of a very specific hypothesis. Let's see how it's shaping up. Okay, so this whole thing kicked off back on February 5th, 2026. What you're seeing here is what the framework calls Phase 1. Think of it like drawing a map before the journey begins. This geometric shape laid out very specific price levels and, crucially, an 18-day time window where the S&P 500 was expected to operate. Now here's where it gets really interesting. You'd think the cycle would just go in order, 1, 2, 3. But nope. The market took a weird detour. It went from Phase 1, jumped straight to Phase 3, and only then came back to Phase 2. This unconventional path is absolutely central to understanding everything that happened next. So, let's dig a little deeper into that initial structure. What exactly were the lines on the map? The whole structure was anchored by two entry points, M and PC. You can almost think of them as two different starting gates. Together, they formed this trapezoid shape that came with that hard 18-day deadline. And inside that shape, you can see three targets, T1, T2, and T3. Those were the key checkpoints the price was supposed to hit. Okay, so that was the plan. Now let's see what the market actually did. How did the price move once this structure was active? And here we go. You can see it right here. The market dipped down to that second entry point, PC, and then bam, it reversed and shot straight up, hitting the peak of that inner triangle at point N. According to the framework, that move right there was the completion of Phase 3, and it happened right inside the time window. But here's the twist. After hitting point N, the price was supposed to keep climbing up to that top boundary, T3. It never made it. Before that 18-day clock ran out, the upward momentum just fizzled out. Now, you'd think that once the time was up, the whole map would just be irrelevant, right? But check this out. The price levels from that original structure stayed in play. The market didn't just wander off. It started bouncing around inside the lower part of that original shape, almost like it was trapped. And the bounces weren't random. The price was clearly ping-ponging between three specific points. That secondary entry PC on the bottom, the apex end that it hit earlier, and T1, which was the floor of the original trapezoid. It just kept ricocheting between these levels. And this wasn't just a one-time thing. It kept happening. On March 2nd, it went from PC to T1. On March 4th, it did it again. And then again on March 10th. This repetition, happening long after the original time window had closed, is a really big deal in this analysis. All of that repeated movement didn't just keep the old structure alive. It actually forced it to morph into something bigger. This is what the theory calls a fractal extension. This side-by-side really tells the story. On the left, you've got our small initial map. But look at the right. All that bouncing back and forth effectively used those smaller shapes as building blocks for a brand new, much larger structure. Let's zero in on this new, evolved formation. You can see it has a much longer time horizon. But the biggest change is that it's pointing to a new, much higher destination, a new apex, labeled N1, which is way above the original structure's top. So, to give it a proper name, this whole process is what the framework calls a fractal extension. The key idea is that the market's repeated actions didn't break the map. They actually reinforced it and caused it to scale up into a bigger version of itself. And what is that new ambitious target? Well, the peak of this new evolved structure, the new N1 level, is set at 7224. Which brings us to why we're here. This whole thing is being documented in advance, so we can all watch and see what happens next. There's a quote from the source material that sums it up perfectly. The thinking is that the structure didn't fail to reach its first target. Instead, it transitioned, using that energy to build this bigger, extended formation. So, the big question is, what happens now? How will we know if this new, bigger map is actually valid? Well, the record laid out some very clear rules. It's considered a success if the price hits or gets really close to that 7224 target. It's a partial validation if there's strong upward movement that still respects the new shape, even if it falls short. And failure? That's simple. The floor of this new structure completely breaks down. And let's be super clear about this. This is being presented as a structural hypothesis. It is not a prediction. It's all about setting up a framework and then seeing how the market behaves relative to it. And of course, we have the all-important disclaimer. This is part of a public documentation framework, and it is absolutely not financial advice. The source material is very direct about not investing essential funds and says that using leverage above 10 is prohibited. So the observation of this structure is happening right now. The ultimate test is simply what the market does. Is this a real pattern in the market's DNA, or just an interesting coincidence? Well, the chart will eventually give us the answer. If you want to follow the documentation, you can check it out at marketdnaedge.com. Thanks for tuning in.